So, yesterday the Federal Reserve just wrapped up its meeting and as many expected, rates are holding steady. But if you look at the market, it's a whirlwind of conflicting analyst opinions. Economic projections are shifting. GDP growth for 2025 has been revised down to 1.4%, while inflation forecasts are ticking up. With all this noise and talk of unemployment potentially climbing to 4.5%, what if the real story for stocks is actually one of fairly contained movement? And what if the euro isn't on the brink of a collapse or a massive surge, but is instead setting into a new equilibrium? Hi everyone, this is George, and today I'm cutting through that chatter. I will explain why I'm predicting a surprisingly stable stock market, likely moving just plus minus 4%, and why I see the euro trading in a 113 to 117 range by the end of the year. Most importantly, I will walk you through my exact investment strategy to navigate what I see coming. Alright, so the Federal Open Market Committee, the FOMC, has decided to keep the benchmark interest rate in its current range of 4.25 to 4.5%. This is the fourth meeting in a row where rates have been left untouched, signaling a cautious stance from the central bank. Fed Chair Jerome Powell emphasized that while the labor market shows strengths, inflation is still stubbornly above their target. Because of that, they are not quite confident enough to start easing policy just yet. Looking at the Fed's latest summary of economic projections, there are some noteworthy changes. GDP growth for 2025 is now pegged at 1.4%, down from the earlier 1.7% estimate. This suggests a more cautious view on economic momentum, especially when you factor in ongoing tariff uncertainties and geopolitical tensions. At the same time, inflation forecasts have been nudged higher. Core PC inflation is now anticipated to be 3.1% up from the previous 2.8%, and the total PC inflation is projected at 3%, an increase from 2.7%. And to add to all that, the unemployment rate forecast has also seen a slight increase to 4.5% by the end of the year. Still, despite these revisions, the Fed is continuing to signal the possibility of two rate cuts by the end of 2025, though the actual timing will heavily depend on incoming data. Now, while some analysts are calling for significant market swings, my own analysis points to a more constrained environment for the stock market. I think it's likely to remain within a plus-minus 4% range from the current levels for the rest of the year. This view is largely based on the idea that the Fed's somewhat dovish tilt, particularly the signaling of those two potential rate cuts, will act as a counterweight to the macroeconomic and geopolitical risks we are seeing. We do anticipate positive earnings for 2025, but this could be offset by downward pressure on stock valuations, thanks to interest rate dynamics and potentially higher bond yields. The market appears to have already priced in a degree of moderation, with forward price to earnings ratios sitting near recent highs. This suggests that substantial further upside might be limited unless we see some really significant positive surprises. Conversely, the prospect of monetary easing later in the year could provide a floor, preventing a dramatic sell-off, barring any major unforeseen shocks. So, all in all, a range-bound market seems like the most probable scenario to me, although expect some high volatility. Turning to the euro against the US dollar, I anticipate it will fluctuate within the 113 to 117 range. Typically, you would expect Federal Reserve rate cuts to weaken the US dollar. However, the situation is a bit more complicated this time around. Europe is grappling with its own set of economic headwinds and is showing some potential signals of contraction. This could limit the euro's ability to gain significant strength, even if the Fed does start to ease its policy. The European Central Bank is also navigating its own monetary policy path. Some ECB officials have expressed concern over the weakness of the Eurozone economy. This dynamic, where both major central banks are potentially looking at or implementing accommodative policies, can lead to more of a balancing act in the currency market rather than a strong, clear directional move for the euro-US dollar. I believe the interplay between Fed actions, ECB policy, and the relative economic performance in the US versus the Eurozone will likely keep the pair trading within this defined corridor. Given this outlook, my investment strategy is focused on a three-pronged approach. First, I'm looking to capitalize on profitable stocks now. This means taking some profits on stocks that have appreciated significantly, particularly those that have seen major outperformance in recent months. The goal here is to lock in those gains before any potential market stagnation or a modest pullback within the plus-minus 4% range I mentioned before. Second, I'm holding a higher than usual level of liquidity. Cash provides flexibility, and that's crucial right now. In an environment where markets might trade sideways or experience short-term dips, having cash on hand allows me to capitalize on opportunities without being forced to sell other assets at inopportune times. This liquidity is key to a patient approach. Third, I will be targeting dividend stocks and broad market indexes on any dips. I'm focused on finding better entry points rather than chasing current prices. For instance, if the S&P 500 sees a decline of around 5% from its current levels, that will be a trigger for me to consider adding to index positions. If the market rallies further before any dip, my entry targets will adjust upwards proportionately. For example, if a near-term rally precedes a correction, I might then target an S&P 500 level of 5,800 points. The focus will be on high-quality dividend stocks for income and stability, and broad market indexes for diversified exposure to capture any upside from a potential Fed-driven rebound. This strategy is designed to navigate these predicted market conditions by being selective, patient, and prepared for a bit of volatility. So, to quickly recap, the Federal Reserve is holding its current interest rates and has revised some of its economic projections. My analysis points to a stock market that's likely to trade within a 4% plus-minus range, and I see the euro fluctuating between 113 and 117. My investment plan involves taking profits on current winners, maintaining significant liquidity, and strategically re-entering the market through dividend stocks and indexes during any potential dips. This kind of market environment really calls for a disciplined and analytical approach. If you found this analysis helpful and want more insights into navigating these complex markets, please subscribe to the channel and like this video. I'm also really keen to hear your thoughts. Do you agree with these market's predictions? What are your investment moves? Let me know in the comments below. See you all next week. Bye bye.